Hello, everyone. Good morning and welcome to the webinar, How to Profit from the Emergence of Crypto Infrastructure. For today, we'll be focusing on a case study of Chainalysis. My name is Mike Huskins. I'm the Chief Legal Officer of Nickel, and our two esteemed presenters today are Dan Siciliano and Enzo Villani. Dan wears quite a few hats. He is a serial entrepreneur, corporate executive, venture capitalist, and independent director. Dan is currently the co-founder and CEO of Nickel. Nickel is a technology company that provides capital and liquidity to unicorn companies and their employees. And for investors, Nickel enables access to these unicorn company returns with substantial downside protection. Dan is currently the chair of the Council of Federal Home Loan Banks and the former chair of the board of the Federal Home Loan Bank of San Francisco, and he's now an independent director on that board. Enzo Villani is a serial entrepreneur, investor, and corporate strategist. Enzo holds several advisory and board positions, including CEO and CIO of Alpha Sigma Capital. He's also the chairman and CEO of Blockchain Moon Acquisition Corp. And the chairman of Wire.network. Alpha Sigma Capital has realized returns on 8 unicorns since its inception in January 2020, including Quant Network, Audius, and Splinterlands. Enzo was previously the managing director of strategy at NASDAQ and co-founder of NASDAQ Corporate Solutions. And Enzo holds an MBA from Cornell University Johnson School. And with that, I will turn it over to Enzo to kick off today's webinar.
Mike, thanks a lot. I think the first thing that I do want to say is thank you for having me on this great webinar with Dan. Dan is also one of the advisors to our funds, and brings a world of depth and knowledge, both from his banking background, his Stanford fellowship and teaching at Stanford and so on. So there's a tremendous amount of value that Dan brings to the actual crypto type community of the blockchain world, the blockchain economy. So we just want to cover a couple of things. We know there's been a tremendous amount of what we call FUD, fear, uncertainty, and doubt. People don't know what that means. And we want to show you the reality of this first so that you get a good sense of what's happening, what's truly happening. There are some resources that will also if you leave you with once this actual kind of webinar is over, we can send you a list of different places to look at real data and real charts as to what is actually happening. So, we have quotes from Chamath that I think most people on this webinar will probably know who he is. He's the person who has done a tremendous amount of SPACs, but really he was at Facebook and kind of created a lot of that type of data analytic research that we see how Facebook runs for the last 20 years. And he said crypto is dead in America, meaning that the United States is falling behind, primarily because they had a real cloudy view as to what was on kind of determining what really was a security and what is not, what's a kind of commodity and what is not. And then, of course, guys like see Charlie Munger, who we all love, Warren Buffett. We think he's a successful and great entrepreneur and holder of fantastic companies, but unfortunately, a lot of times, and kind of history has shown this. The people who are in control of the economy usually do not like to give up that control, nor do they want to admit when there's something new in the kind of technology sector that's going to change their world dramatically. Now, Chamath believes in blockchain and crypto, and there are many people, including folks at age 16Z, that have dedicated their entire kind of career now to this entire industry. When you compare it to what's being said to the charts, and these charts are as most recent as March or April of 2023, the activity is going up. There's two major KPIs that Alpha Sigma Capital looks at when we're looking.
Hey, Enzo, I want to ask you a question because you're such an insider on this. Sorry to interrupt. I just want to. So, do you think that this resistance to crypto broadly, which you're about to prove is factually incorrect. Like there's a slow progression, but like the Charlie Mungers of the world, but there's lots of others who just kind of dismiss it outright. Is that a generational thing? Is that what's in place really works for them and they just don't want change? I just wanted you to expand on that for a minute or two, because it's sort of relevant to some of the stuff we're going to raise.
So I'm in a few groups and chats, and one chat is a global chat of probably all of the OGs in crypto, top people. If I name, I don't want to name them because I don't like name dropping, but top folks. And the conversation around this is, there's a couple of reasons. One, we think that the United States is trying to give the crypto community, give the crypto business or blockchain business to the people who they trust, big banks, folks who are basically in charge now. Unfortunately, it's the antithesis of what they should be doing, because blockchain is the great kind of equalizer, for many people who have become wealthy by not having to go through all of the hoops to get a bank account. There are people who cannot get a bank account, and it's not because they're bad people or they're doing a kind of nefarious act. It's that the banks don't give them accounts because they're too small. So this is something that I think that, when you look at the kind of developer type of community, which is one of the biggest KPIs, the active Web3 developers, where are the people going to write code? That's where tech is going. I bet you if I match this chart with the AI chart for Web3 developers, you would probably see that slight decrease that we're seeing because it's a crypto winter. And there's 4 seasons of Bitcoin, which is another, whole webinar. But the idea is that as the cycle starts to move, you will see the actual developers over time increase, which is an indicator that people want to be in the Web3 industry and believe in it. So
That makes a lot of sense. Yeah, no, I think we'll probably talk a little bit more about this because, Chainalysis follows this particular pattern and crypto generally, but these disruptions are like abhorred by those who kind of administer the prior, system. And if you look at, when corporate kind of capacity, when the ability to create corporations came into being and was taken away as an exclusive power of the crown, and people thought the sky was going to fall. You have these hilarious quotes that say something like, the godlike power to grant personhood to a non-person, now in the hands of a bureaucracy, the world will end, right? As opposed to literally the English crown saying, you are a corporation, you are not, you are a corporation, right? And then even with the stock exchange in the United States, this idea that you're going to allow average people, heaven forbid, to buy and sell little pieces of a company, that is crazy. The world's going to fall apart, right? Because and again, at each stage, the takeaway, I think, and that hopefully you'll be able to address a little, is that it's disruptive. People don't like it. It has some big problems. It always does, right? But they resolve it, and then this whole industry rises up around the new thing and supports it. And that's a lot of what I think we're interested in today, is that whole infrastructure. Like, if it's going to exist, it has to ultimately conform and comply with most of the world's regulations. If it's going to exist, it has to talk to normal people. Like all those things end up popping up around it.
Yeah, so I think the issue is that since 2013, the U.S. government has known about crypto and blockchain, and they let it ride along, and then now they decided to do what they wanted to do. So that's the negative part. Now, on the other side, like any cash or any currency in the world, and the U.S. dollar is known for being the biggest money laundering currency in the world because it's the largest, it's the reserve currency. So by default, this, Bitcoin has been used for kind of nefarious, reasons. And the good thing now is that we have tools and technology. So there's 2 issues. One is, when a new technology comes to bear, in order for it to gain any traction, it has to be the radical thinkers. It's usually the radical thinkers and radical type of developers that will get something accomplished. The Bitcoin, white paper, all of that. Now that the industry is starting to mature, the industry is 10 years old. It hasn't been born yesterday. It's over 10 years old. So now that it's starting to affect the market, and I do agree with the U.S. government that it could, like, the stable coin is like a hidden dark market for currency, and not a dark market like in a negative way, but it's like it's not really like, how are they tracking it versus M2? Like,
Yeah, it's
that's
opaque,
the issue,
right? Yeah,
right?
it's opaque. You can't really understand what's going on, which at a certain level creates fear and anxiety, which probably isn't merited, but at another, it's kind of necessary, right? Like if you can't track M2, you don't know what's really happening with like
That's correct.
politicians
So I
are
agree
gonna
with
do
that. And before
something,
it
right?
gets out of control, you have to put some type of controls in. It's just that the way that they're approaching it, unlike, MiCA laws in Europe, they have a sandbox, 11 months to comply. They wrote the rules. They've initiated those rules. There's no reason not to do that here. But unfortunately, we're not in that place. But at the same time, just to show a ray of light, there have been two companies that have been approved for the broker dealer custody license to hold crypto. That's the OTC markets and a company called Promethean. Great, let's go. We're all ready to go. We're all ready for the regulatory sandbox. We all want to be in it. So I think that's something that's really important. Now, the Chainalysis world shows you how important it is, because if you look at the customer list of a Chainalysis, it's not just the DOJ and the FBI and the IRS. It's literally every major crypto company in the world and every fund, because no one wants to be a bad actor. Like 99% of the people who are in the blockchain economy are not looking to be bad actors. They're looking for the financial freedom. They're looking to transact in a frictionless environment. They don't really care. They know that our permission system that's controlled by centralized entities is really not what they want. They want a decentralized system. So now in blockchain, be quite honest, is the most efficient way to track money laundering. It's better than what banks can do.
This
Government
deserves like half a minute, because I think you're right about the government and then the first impressions of this and letting it ride and not understanding all the dynamics. This has been many, many years, but a guy who's just gone on to do remarkable stuff, Tino Cuellar, who is a professor at Stanford Law School, and then took a little bit of leave because he was put into the Obama administration, and he was doing a lot of interesting stuff. But before coming to the law, he was actually at Treasury and he did anti-money laundering. And so he and I had this conversation once, and it followed these lines, which was this idea that that blockchain, and at the time, because this was many years ago, really there was just Bitcoin and even Ethereum hadn't really emerged. This idea that this was this dark, nefarious pool. He observed several things. I don't remember the exact percentages, but it was something like, of the people carrying around a substantial amount of cash on their person, like 1/3 of 1% were up to no good. The rest were just carrying cash on their person, right? Like, yeah, but that 1/3 of 1% in terms of like volume and bad acts, actually, because there's a lot of cash floating around, adds up to big numbers. But we've gotten past the notion of concluding that anyone who carries cash must be about to commit a crime, right? Like we don't think that. And this was, I think a decade ago at this point, and he had the foresight to think about the fact, he goes, I think we're going to go through this period where people were like, you touch Bitcoin, you must be something bad, right? Why would you do why would you use blockchain? And he already had the insight that in reality, though, if you can connect the on-ramp and the off-ramp, it's a perfect forensic record of everything that happens with all those transactions. So I think all of this stuff gave rise in so many ways. And by the way, he went on to, you don't often leave tenured spots at Stanford Law School, but he did, because he got appointed to the U.S. to the California Supreme Court. You don't often leave that.
And I bet you he owns a lot of Bitcoin.
Well, I don't know. He's such a modest, interesting guy, but now he's head of the Ford Foundation. So and they're kind of cutting edge. So I bet they invest in Bitcoin. But here's my question for you, and maybe the kind of segue to the next concept, which is, now that there is a growing understanding, even that the United States is behind, but globally, certainly there's an embracing of it. We know how blockchain works. There's inevitable use cases, is evidenced by the big banks engaging their own projects. There's that tug of war about
right.
to control it, but you've got these developers moving in that direction. So if you think that blockchain and crypto as an entire space goes to zero, you should hop off immediately off the webinar, because the rest is not going to be of any interest to you. But if you think it continues as a phenomenon and ultimately becomes, you can believe it's only going to become medium, or medium big, or big or huge, any of those make it relevant to then ask, Enzo, who is it that's playing a role in this infrastructure and forensic observation? So, it turns out that, all the governments of the world actually now get it, and they
Right.
they need people to say, hey, we think this thing happened and we want to follow the money, right? Or the
Well,
Bitcoin.
they're also creating CBDCs, which is basically their own version of a Bitcoin, right?
Yes.
And that's going to allow them to track every dollar, every digital euro, every digital LATAM dollar in the world. So they will be able to follow whoever's holding that currency all the time. And
when we say trace, like I know a lot. I just spent some time in DC during this debt crisis thing. These are all very talented people in many ways, but I got to tell you, these are not folks who can back up their own computer. They certainly can't set, some of them have recently let go of their AOL account. They're smart folks in what they do, but they are not technological. Like, who are the companies or the services that these government entities and players are going to be utilizing to do this stuff? Like, I get it. They can trace, they can track, but they're not doing that themselves. I mean, maybe someday, but it strikes me that there's no in-house talent typically for this kind of work, and it's quite technical.
You will see in the future, you'll have both regulated, you'll have the regulated, this is what I think it's going to happen. You'll have the regulated space, and then you'll still have a little bit of an unregulated space. The unregulated space might be regulated, but just so small transactions that it's not being tracked as heavily as, let's say, if someone moves over 10,000. But in the CBDC, they're going to leverage blockchain technology and actually tokenization, their own stable coin, basically, to be able to track everything. I mean, there's a benefit to the governments being able to do that, because if they really want to stomp out like money, they'll be, that will be pushed completely into a dark system. There might still be a technology system that's doing it, but they will not, most likely they won't be using dollars anymore, or they won't be using euros. I mean, why would it's almost like I think the future is going to be quite different when it comes to how transactions happen. And then if you layer AI on top of it, and AI is intelligent enough to also do tracking, as well as AI on the kind of nefarious side, I think you're going to see a world where a lot of transactions will be happening across borderless. It'll be borderless, multiple chains, interoperability, crypto, CBDCs, securities, everything.
Yeah.
And because of that, you'll have to have, but everything will be in mostly public ledgers, which are compute systems, really. If you look at blockchain, it's more than just a public ledger. People say, oh, it's just a ledger. It's not, because it has smart contracts written in it, which is actually a programmable language. So they're programming the ledger. The ledger is a program. So it's a compute system. So yeah, I think, and the companies that are going to be tracking these, data and analytics, AI can't live off of anecdotes. So if you want AI to be effective, you need data and analytics in order to execute transactions. It can live off of, in a creative way, anecdotes, but it can't parse things easily, right? So it'll parse things much easily and faster if there's data on everything that's flowing around the kind of financial system.
So this is we should go to the next slide, I think, Mike, in part because you've just connected, two hot topics near and dear to my heart. And I kind of want us to kind of walk through that landscape a little bit. So you've observed that for traditional reasons, regulators, companies, authorities, law enforcement, they all need and want, data and analytics for the purposes of monitoring what's going on, or, just understanding what's happening, right, with transactions. And that takes kind of technical capacity, and it's technically capable. There's a wider opportunity to do so than in the current economy, because there's almost no place that's genuinely opaque, right? Since it's all on a blockchain, and most of it on public blockchains. But, and then you raise this other issue, which is, then there's another reason to have visibility, understanding, and gather up all this data. It's for AI machine learning applications, which allow you then to refine, additional, strategies and other stuff that you might want to do in this space, but you got to actually scoop up the data and organize a special way. So my question is, who are the players that are legitimately engaged in this sort of under the hood, almost forensic tracking, analytics, data gathering way in activity? Who are some of the players? And like, I know a lot about analysis.
Yeah,
and some of the others,
so we have a list here. So Chainalysis is the leader in that. For like, they took the lead. The way they entered the market is they took the lead on being that forensic tracking system for investigations. Like I just saw something from May 23rd, an interview where there are thousands of investigations being done using the Chainalysis platform by IRS, DOJ, and other governments, and so on and so forth. They've, there's some great stats. More than $10 trillion is monitored, more just as like Visa and MasterCard, 11 billion. And now don't forget, this 10 trillion is the size of Visa and MasterCard monitoring, but we're still in a very nascent new world in the blockchain economy. To the $11 billion in industry stolen funds. I mean, that's amazing, right? So they're helping to combat, because there are sponsored states, there are state sponsors like North Korea that is literally all they make money, like their job. It's like it's like the mob. Like their job is to go steal funds and money launder.
Right.
Like that's what they do for a living. And then they've identified $12 billion in the illicit kind of direct, kind of transaction flows. And if you look at the competitors, like the Masari guys came in through almost like a Wall Street research approach for crypto, then data analytics, then investigations.
Okay.
So it depends on who you're speaking with, where they kind of lead, but they've also added this other service. Some of them are actually partners of Chainalysis.
Yeah.
So they take their actual data dashboard, and I think they're more catering to what I would, like the crypto traders, funds, the companies who are accepting crypto as payment. So they're kind of taking their niches, but it's all based on the same thing. Like we have a company called actually, so the name of the app is Dopamine. Yeah, it's called Web3 Intelligence. And the name of the token is Dope. I mean, it's like kind of like a fun app. It's got some games on it. And he just showed me this actual new feature, which is I can plug in any wallet and it'll tell me if it's transacted with a bad actor. So if I am talking to someone and they want to send me crypto, this is more of a crypto thing, right? I can look up their wallet and see if they've ever been involved in any kind of bad actor type of, FACFA, or like the entire thing. So I was like, and that's on a consumer app.
Right.
That you
right.
can play a video game.
Which is actually quite remarkable, right?
Sorry?
It's actually
amazing,
quite remarkable.
Right? I mean, he has about 3.1 million downloads. But and this is a small firm, really. It's quite a small company, still making its way through the process, right? And what's interesting to me is when you look at these firms, like kind of Nansen is more of a data chart analytics shop, but they're all doing the same thing, is everybody wants this data, which is, if we're going to live in a world where we all know that things can be permissionless, which means you don't have to know who's on the other side of the actual transaction, right? They can plug into a DeFi platform. As long as someone is monitoring the playground, the bad actors are not in the playground. Like when you go to let's use the actual term, a playground, you're going in there, everybody who's in there is being checked at the door and saying, okay, you're fine. Now, you may not know each other, but you're all seen as, I would say a good actor, but just a normal actor, not a bad actor. So it's very similar. And what's interesting is that you could literally do this across every transaction. Like when you go to a retail store and you sell something to a person in retail, you could literally get it down to that level if you chose to, which is interesting, but also quite like concerning, because what happens if someone has, a little, it's almost becomes like what I get concerned about is social credit scores. Right. Like someone didn't pay their, kind of utility bill and now they can't buy something at a store. Like that. There's
good news and bad news there, right? The bad news is this is legitimately something to be anxious about and to monitor. The good news is that maybe it's also bad news. The good news is that it's already there. Like we have that, and depending on what country you live in, you have that. And so what's intriguing is that this analytics around Web 3.0 and blockchain doesn't introduce this in a new way. It simply accelerates the potential.
It makes it more efficient.
Yeah, it makes it a lot more.
It makes it super efficient and it makes it cheap. if a app can actually have this type of tool to utilize it, I mean, that's pretty interesting to me. It's just a different world. So net though, everyone is going down this path. Like there is not one group in blockchain and crypto that's what I would call a normal actor that is not going down this path, including my fund. Like my fund, we check wallets all the time. I mean, it's always checked. We always do KYC and basic AML. You have to, right? So that's for a fund. That makes sense. But you can do this across multiple DeFi type of systems and so on and so forth. You're going to need Chainalysis type tools. Elliptic is one firm that kind of sprouted up. There are still some different types of competitors, but most of them are doing very similar things, which is in some ways sharing the dark list, right? Which are the dark wallets? Which are the wallets that you do not want to interact with? Now, that doesn't mean, now, of course, it's a cat and mouse game for anyone who's on the nefarious side. They just spin up a new wallet. So you have to continuously be monitoring, and what they're learning what to do is, I think they're also using other tools in order to understand that better. I don't want to talk about the other tools because they might scare people, but like GPS, stuff like that. So
let's but let's talk broadly, and then I'll kind of do a recap here about the opportunity in the total addressable market. So if you wear your more traditional venture capital hat and your investor hat for growth technology firms, one of the things you look at is, okay, how big is this market itself? And just the kind of meat and potatoes part of it, which is blockchain monitoring, analytics, anti-money laundering, know your client, know your customer stuff, plus investigations driven by government players. That's a big market. It's a multi-billion-dollar market and it's growing quickly. But what you just finished talking about, I think, is the part that's very much underappreciated, but certainly understood by the Chainalysis and the Nansons and the score chain folks. And that is the opportunity to wed AI, lots of data, other analytic insights, GPS, etc., and to then take that and create lots and lots of different product opportunities, some of which we can kind of imagine, others you won't readily imagine, that provide utility. So at the consumer level, easily checking for validity of an account, bad actor, not bad actor. But realize that there's also preferences. So in the near future, you can have patterns of transactions that conform with a particular ESG profile if you want, right? Or that indicate a concern about behavior if the person's a minor and you're their parent. Like there's 1,000 product offerings that emerge from the sophisticated analytics, and that's not even counting the opportunity for this just tremendous, this tremendous analysis requirement that's just regulatory compliance. And so I think what I want to highlight before I kind of hand it over to Huskins here, we've got unless you think crypto goes to zero, crypto requires support, infrastructure, traditional audit. Kind of imagine the big four, but in the crypto space. It's already quite large. The question that then comes to mind is, why haven't more people heard about these different companies? Well, first, if you're inside the space, you have. But another reason you might not have is because the likes of Chainalysis and others are not actually actively, first of all, they're venture funded, they're a unicorn, they're private. They're not
B2B.
They're not particularly active on the secondary market. And the reason why is because in crypto in particular, it's been a very cold winter and there's a big downdraft. And it doesn't matter if you are a company that's outperforming every possible metric, which is Chainalysis in this case, by and large. You're caught in the downdraft. And so, most people who are on the inside would never want to sell. They don't want to get rid of their shares. They don't want to, they don't want to miss the opportunity because at the moment it's probably undervalued. So with that in mind, you ask the question, how can mere mortals like us, not giant VC players or, the Tigers or the SoftBanks of the world, how can people get an opportunity to invest in that kind of company if they're not putting something on the secondary market? And by the way, secondary market is not easy to navigate either, but at least it's something. And it turns out the answer is to create something that people who have options inside the company, they're fully vested, would want to give you a piece of that somehow, because there's an opportunity for them to get capital, exercise their options, turn into a share, and most importantly, transform what would be ordinary income into long-term capital gains, lots of savings. So you want to find the people who believe in the upside and don't want to give up the upside, but would like capital right now, and in exchange for that are willing to give investors, directly or indirectly, the opportunity to benefit from the increase in value. So it's a different way into the likes of Chainalysis, rather than knocking on the door of the secondary market, where there's a whole bunch of secondary market sales. You got to ask yourself, why are there so many secondary market sales? Why are people selling these shares? And on the other hand, if there's none, you say, why is that? And it turns out that in this case, it's because people hold them dear. So with that in mind, I'm going to hand it over to you, Mike Huskins. This new product idea, I guess, isn't so much new. I mean, I think this idea of the mechanism, the contracts that are being used to replicate this opportunity to invest in unicorns, it's been used in other areas and it's been around for a long time. But I guess this is sort of really a novel use in this particular space. Can you maybe just give us what it is we're talking about, the recap?
Sure. Thanks, Dan. Yeah. And the best way to understand what it is we're talking about is to go through a specific example. So I'm going to go through some numbers and explain how this new product works. It could work for Chainalysis or it could work for other unicorns, but it's a way to invest indirectly in the returns of a unicorn. So here's how it works. So suppose you have a unicorn employee and she has vested options for 100,000 shares. And let's suppose that those shares today are worth $25 a share. So the total value of those shares, once she exercises and holds those shares, would be $2.5 million. This is what Nickel does. We would approach her and say, we can offer you at a capital to value ratio of 40%, we can offer you $1 million today. And in exchange for that $1 million that we advance to her, she enters into a variable prepaid forward contract. And you can think of that a little bit like a loan, where we're giving her money up front. That $1 million, then she takes and she exercises her options. So she would pay her strike price, pay the ordinary income that is due on the non-statutory options. She would pay the AMT, alternative minimum tax, that is due on the incentive stock options. And after paying the strike price and those taxes, she might have $100,000, $200,000 or so left over for liquidity. So she now owns those 100,000 shares, and she's entered into a contract with us that basically says, when there is a liquidity event, so a IPO, a direct listing, sale of the company, tender offer, any sort of liquidity event for those shares, that contract needs to settle. And what settlement means is that she will return the capital that we advanced, as well as a fee based on the future value of the shares. So in this example, let's suppose 2 years later, this company goes public, and those 100,000 shares are now worth $7.5 million. So a 3x on the underlying shares. According to the contract, she would have to settle, and what that means is she would first pay back the $1 million that we advanced to her, and then she would pay a fee based on the future value of those shares. In this example, it's about 12% fee on the $7.5 million. So that's how you get to the total payback of $1.9 million. And in this example, the investor return is close to 30% internal rate of return. The employee is better off in this example because of relative to holding the shares and waiting for the IPO, because of the tax savings. So what happens is when she exercises today, she pays ordinary income on the value of the shares at that moment in time. But then all of the appreciation after that, so that appreciation from 2.5 million to 7.5 million will be taxed eventually at capital gains rate, which in most jurisdictions is roughly half that of ordinary income. So even after paying the fees to Nickel and our investors, she's better off. investors also like this approach because it's a way to get access to an investment you might not otherwise get access to. You're investing with a shareholder who wants to keep their shares, not somebody who's desperate to get rid of them and make you question, why are they selling these? And we structure the returns as the fee is both progressive and marginal, which basically means the higher the value of those shares go, the higher the percentage that will be paid to investors. And so it's a way to capture some of the upside, and the employee is willing to share that upside, because if she's doing well in this example, we do well at the same time. So that's an overview of how the product works. Dan, I'll kick it back to you. Anything to add or
I think you said this, but it's worth pointing out, this idea of a prepaid variable forward contract, that's been around for a long time. There was a big deal, in the late 90s and the early 2000s, as it kind of sorted out as that tax advantage, meaning you get capital now and you don't have to pay taxes on it. That whole process has become pretty standard. There's revenue rulings on it. The Treasury has a view. Congress made some modifications. There was some litigation. So that's interesting that's settled, and so that's reliable. But why do you think we didn't see this sooner in this particular space, this application for unicorn employees that have vested options? It seems like such a good fit. I'm sorry to ask you a question out of the blue. Like why didn't this come up sooner? And one good answer, by the way, is that you and I and our fellow co-founders were just so cutting edge and so smart that we brought but what's another answer? Like, why didn't we see this sooner? It's such a nice solution to such a hard problem.
Well, I like that answer, that we're so cutting edge and so smart, but I'll give a better answer than that. I think it's in part, so this market has existed for a while. So it's just been a very nascent market and hasn't been very active. Part of the challenge is that people don't know what a variable prepaid forward contract is and how it works. Part of it is that there's some legal technicalities here about how do you pledge the shares without violating the company restrictions on hypothecating, pledging, or transferring the shares. We've addressed that by using what's known as a springing pledge, which is it's been around for a while, but it's relatively recent invention in the law that allows the person to say, I will pledge these shares as soon as I can. But for the moment, that's sort of a pledge that doesn't come into play right away. It springs into play later on when the person can. So I think it's been a combination of things that have allowed this market to start to grow. And I think it's also a function of, venture capitalists and private equity mindset of wanting to own shares. And, I think many would say in that world that, well, employees get liquidity at the IPO, or we can do a tender offer for them, but it's not really a tax optimized strategy for employees. So I think it's been something that's been overlooked, and that's one of the reasons why it's not a bigger market, but it's certainly growing, and it's certainly something that employees are quite excited about because of the tax optimization and the opportunity for liquidity.
That makes a lot of sense. And I think that transition from a market that's been in place for a long time to something that got a lot bigger, I think smart investors over the last several years have probably started to realize that the opportunities in the public markets, the growth technology companies that IPO and then have 100x stretch, if you're lucky to increase their valuation, has become much more rare. And it's not because there aren't great companies, it's because that stuff happens while they're private, right? Which kind of brings us back to the main point here, which is Chainalysis is going to be, I think, a really great example of that. It is a company that is going through ups and downs because the market's going through ups and downs, but it's actually a very, reliable performer. And I think depending on how you view these things, you hold it up to competitors and the like, and you walk away saying, wow, this is a really great company. In a bygone era, meaning 20 years ago, they would already be public. right? They've got substantial revenues. Their profitability is a function of deciding whether or not to invest in growth or not. So if they invest in growth, they're probably not cash flow positive. But if they decided not to, they probably would be cash flow positive. And so that's the typical, 1993, 1995, 1996, go public, right? But now we wait because they can get so much capital from other sources. They wait and wait and wait. So the opportunity to invest in a $300 million company that becomes a $30 billion company, well, now once they go public, you have the chance to invest in a maybe 10 or 15 or $20 billion company that probably might become a 40 or 50 billion company. That's nothing to sneeze at, but it's not your 10x or 20x. And so the reason that Nickel came to be was to solve these problems for unicorn employees, but bluntly to also play an egalitarian role, a sort of equalizing role for the 10 or 12 investors that we all know who get access to this stuff on a regular basis. Some hard fought. Sequoia has to invest billions of dollars in hundreds of companies, then they end up with 10 or 20 like super amazing unicorns. That's a tough go, and they're good at it. But I think it makes sense to therefore say, well, is there any way we can get in on it? And that's what we do. So Nickel in particular, in this case, we have we do a lot of stuff, but two ongoing opportunities. One is an ongoing investment in Chainalysis. We're putting together a special purpose vehicle, which is fueling funding for our product. There are several people within the company at the highest levels and very excited about the opportunity to not have to get rid of their upside by selling their shares, but an opportunity to tax optimize the way you described. And so there's that opportunity. It'll probably be in the end an SPV of anywhere from 5 to 20 million, depending, and it gets access directly with the returns we highlighted into Chainalysis. So if you are excited by crypto and you think that there's a future there, and then you believe in the idea that the infrastructure will be necessary, and you look at Chainalysis, then you would probably be very attracted to this opportunity. So if you're interested in that, we're happy to talk to you and to give you an appropriate prospectus if you're qualified as an accredited investor, and to walk you through that opportunity. Additionally, as what we do every day, we have another SPV that, as it turns out, it might be oversubscribed, which is super exciting. But we are good at finding employees who want to participate in this process, and so we think we can expand it a bit. But there's an SPV that's targeting about 6 soon-ish to IPO companies that are also just tremendous values. The Turos and the similarly situated companies of the world. It's a moment in time, and they're probably going to go gangbusters. And at the moment, their valuations are lower than they were, and it's just a great opportunity. So that's the opportunity we have. If you're interested, we can certainly set an appointment for you. You do have to be appropriately an accredited investor, but I'm happy to talk to you about those two opportunities. Special purpose vehicle for Chainalysis, chance to get in on what we think is just a wonderful opportunity, and an opportunity to do a more diversified special purpose vehicle with several pre-IPO technology companies that have a lot of the same features. They just happen not to be in the crypto space as Chainalysis. So I think what we want to do is just switch to kind of Q&A. And I know, Mike, you have some questions that you've been looking at and gathering, and we can maybe turn to attendees if we like, but I'll let you go first. And Enzo, I think you and I are any questions fair game. So we'll see if we can answer the things that Huskins comes up with.
Yeah, no, thanks for that. Yeah, we've already started to get some questions rolling in, and if folks on the line want to send more, please use the Q&A button in Slack. But so the first question, I guess, for both of you is that it seems like Chainalysis has kind of bridged this world of both traditional finance as well as the crypto world and DeFi. How rare is that? It seems like some companies, we certainly have traditional finance companies, and we have crypto companies, but how rare is it? Are there other players that have been able to bridge that gap? And how has Chainalysis been able to do that?
I can venture a little bit of an answer, then ask you to build on it, Enzo. So first, I would say Enzo, I think it's quite rare. And I would say Enzo is a good example of that rare, trait, which is he's super credible and established a whole career in traditional finance. But all along, I would probably observe now, looking back, he was a little more open-minded than your traditional finance guys, and then be, embraced very early and understands, Web 3.0, blockchain, crypto, and the like, and straddles both worlds, right? So he can talk to both people, and frankly, they're almost completely different languages. There's just different gestalts and feelings about it. And I think it takes a very particular talent to be able to cross those bridges. But as it happens, that's essential because still, and probably for some time, most of the wealth of the world is on the traditional finance side, right? It is not made that transition. And if you can talk to both, it's quite rare. And my interactions, I've had the privilege of interacting with the CEO of Chainalysis and others. I've watched him transition from, very, cutting edge conversations in the Web 3.0 space, all immediately to like, safety and soundness conversations, in the SEC space. So like, that's quite rare and impressive. And Enzo, I wonder if you agree, and maybe you can give us insight into why we don't see that more often. What is?
I think I think that they have three things going on there. One is that they were early. They were actually first movers. So everyone that came after them is basically trying to replicate what they have and then doing something a little different. But as the first mover, they actually, the first mover advantage doesn't always work, right? But in this case, it did, because what they did was they looked at a space instead of going in and saying, okay, we're going to be another crypto app or something like that, which is more on the edge of the regulatory. They actually brought it closer to the regulatory. So they saw it coming and they got in first. I mean, their last valuation was 8.5 billion, the top val. I mean, was their last raise. They do, and they generate a significant amount of revenue. Like these are real companies. They're not aspirational. They're not like, going to make $1 gazillion in the future. They're actually making serious they're making serious money, have a tremendous amount of clients. And they have some of the biggest clients in the world, where they're the US government. I mean, the fact is that not many companies can say that in the crypto space, especially. Yeah. And I think what they're doing is also something that everybody wants to embrace, because they see that there's a big value there. So unlike the others, and there's, Elliptic is pretty new. The Masari guys, they've been around for a couple of years, but I think Chainalysis has been around the longest, and they were the original. So, kudos to them. The other thing is the CEO is definitely an entrepreneur type person, and I think now they're up to like, I think they have a couple of thousand employees, and they're global. They're in like 30 cities. I mean, this is a significant company. It's not going anywhere.
Yeah, he's one of those rare combinations of a pretty mature, thoughtful, brainiac entrepreneur, right? Like he's got,
and there are no risk factors. Like they're not like a trading. They're not FTX. FTX was like Lehman Brothers, the 28x leverage, 100x leverage. I mean, as a fund, we turned down all of that stuff because we've been here. We were here in 2008. Some of us were here in 1987. But it's like these guys make money basically by selling technology, software, data products, and solutions. It's very close to a data company like a FactSet or Thomson Reuters or an S&P. That's what they're doing. That's the comp. And then the other side of the comp is the fact that they're almost like this auditor. So they have this auditing E&Y, Deloitte, KPMG type of model. So if you look at those, and as blockchain becomes more in every transaction, audits will become, believe it or not, I know the auditors all dropped all the crypto companies, but actually audit will become a lot easier because everything will be right there.
Oh, yeah. You and I should hold a different webinar on the fact that auditors will eventually fully embrace this because it makes the job so easier. It's the owners of the audit firms who will fully embrace this because the reductions in force necessary to get the job done will be so dramatic. It's going to be a painful transition. But if you own the franchise and benefit from that, you do quite well. What other, I know we only have time for maybe one or two more questions, Mike. Was there another question that jumped up?
Yeah. So another question that came in is maybe sort of the other side of the coin, which is, looking at Chainalysis, what are some of the risk factors for an investment in Chainalysis? It sounds like it's well positioned, but every company has risk factors. So what are some that might give people pause with respect to Chainalysis?
Well, Enzo, I'm going to give you a minute or two to think about stuff that's maybe more crypto centric and finance centric, and I can just speak to kind of the markets, right? So the reality, I think, right now in terms of investing in unicorns, let's assume you can invest in unicorn. That's a magical assumption, right? Like we enable that. There's some other strategies, but investing in unicorns, is the price right? Is it the right value? So Enzo, you mentioned that their valuation on the last round was a really healthy, $8-something billion valuation. But just to be clear, this particular arrangement access is at a valuation much lower than that. And that's just because the market has changed. That's actually sort of the opportunity, which is the super smart folks who are still very happy that they invested at a valuation that's 2 or 3 times what it is right now. We've been able to arrange investing at a much lower, price point. So that's the first question. So you can always still be wrong about that. Maybe the world gets harder for a while before it gets better. So that's one risk. The second risk, and it's really the more profound risk, assuming you get everything right, is time, right? So these are illiquid companies. They are private, and there won't be an opportunity to turn all that wealth into liquidity and cash and sellable, securities until they IPO or have an M&A. On the one hand, Chainalysis is well positioned to take advantage once the IPO window opens, but also it's the type of company that the opportunity, the total addressable market is growing so quickly that for every month or quarter that you have to wait for it to go public, it was probably a good trade-off because it will have grown and it's in a very high growth environment. And so there's a trade-off. But those are the two risks. Like, did you get the value right? And did you, and how long is it going to take? I will throw out that the product we designed has a very interesting feature, which maybe about a year and a half ago, people were like, oh yeah, that's nice. But we live in a different world. And that is because of how the capital advance works. And once it all settles, that capital advance comes out first. And so all those shares that the individual, creates by exercising their options with this capital, those essentially secure the repayment of that capital advance. So the way to think about that is if you give someone 40% capital to value ratio for their shares, and we all ended up being wrong. I don't think we're wrong, but let's say the world changed and instead of going up, Chainalysis went down by half and then IPO'd or got bought, right? Well, if you had bought on the secondary market, you would have lost half your money, obviously. But in this case, because of the way it's structured, since all the shares covered that capital advance and it was only 40%, in the settlement, even though they went down by half when they got bought, you get all of the capital back, and then you're going to get a little more. So oddly, in a down environment, up to a certain point, about 50-60% down, you're still going to get a positive IRR. And it is kind of funny, but truly 2 years ago when we'd mentioned that, the people are like, yeah, I don't care about downside. I don't care about downside. Talk to me about the upside. Well, now people are a little more balanced, which I think, frankly, is probably prudent. So those are the risks, and there's one solution. What about the crypto space?
I see it as three as kind of three issues. One is, are you doing this for a short-term gain in the next year or not? You have to think about when is the IPO window going to open up. So that's the first decision. Like if I was making this decision as personal or a fund manager, I would say, okay, what's my risk? What's my time period? I'm looking for a long-term. If you believe that blockchain and all of this stuff, not just Bitcoin, blockchain, CBDCs, applications, all of this stuff, contracts, NFT, all is going to go completely away, then no, you shouldn't be here. But if you think it's going to go where it should be, it has to be tracked and managed by a leader. This leader might exponentially grow faster. That the first mover kind of advantage strategy, and is that you get that kind of acceleration, the winner takes all. In this type of thing, everybody's a customer of Chainalysis. Not everybody's a customer of their competitors. Anyone worthwhile is a customer already. Secondly, what I would say to myself is, what's the risk downside? The risk downside in holding just the stock and not hedging is that, and we were one of the only funds actually last year that hedged out liquid positions that were like venture-esque, because we saw tokens really as a tradable type of commodity or whatever it is, whether you want to call it security or not, doesn't really matter. It's just this tradable thing. And if we can put a hedge on it when we knew the market was going to have problems, why wouldn't we? So
a career in traditional finance actually pays off, right? Like that's the rule of traditional finance.
I didn't know. So Dan's not levering. So he's not levering up, which is important, which would make the downside risk worse, right? He's all, the other thing is that I would say to myself is, what is the downside risk protection that I have baked in? And that's in this model, people like to own, I own SpaceX stock. Okay, that's fantastic. but you're going to go up and down with the SpaceX stock, and hopefully it goes up. Or you get bought out. Like I had SpaceX stock, and one day they just said, nope, sorry, here's your money back. Because we were in some type of micro strategy SPV thing.
Oh, interesting.
I was like, well, that's not cool. But the fact is that if you have downside risk protection, and this model sounds like you have more downside risk protection, not financial advice, but if you look at, and that's why you have to go through everything and really look at what you're actually doing, because this session might be a better way to own. It's cool to go to a party and be like, I own SpaceX stock, or I own Chainalysis stock. And, but now you have some downside risk protection. I think that's something that I would look at. So, but that's really it. I mean,
That's what I've been doing wrong at parties. I talk all about derivatives. I should just be talking about I'm just kidding. And so that's great. That's very good highlight. I think you want to ask one more question.
Yeah, I think we have a couple more minutes. So one more question has come in, and so I think we'll end with this one. So Enzo, you had mentioned that you need somebody monitoring the playground for bad actors. Would like your thoughts and your thoughts, Dan, on how do you see that playing out? Is that a role for government? Is that a role for a private company? Is that decentralized? Is that some sort of hybrid? It seems like that's one of the big challenges of cryptocurrencies is monitoring for the bad actors on the playground. How do you see that playing out? And does Chainalysis have a role in that?
And so I'll let you answer that first. You're kind of deeper expert. I can give a couple government thoughts.
Yes. So if you're going to have a frictionless economy, you have to have some guardrails at some point, or someone watching the store. And you can't watch the store with people. It has to be done with tech, and it has to have. So I don't know if anyone knows this, but there's something called Market Watch. So I worked in NASDAQ for like 10 years, and Market Watch basically monitors the stock exchange, and monitors all the transactions and looks for, insider trading, nefarious type of trading, people doing wash trading, there's rules, right? Crypto is unregulated. It's becoming regulated. So you have to understand that the transactions are all there to see. The interesting thing about blockchain is that it's transparent, but there's also what I would call old TradFi gimmicks being played. FTX is a perfect example. They took an kind of regulated asset and did all of the TradFi nonsense that they could possibly invent in real time in order to, hundreds X, all of the bad stuff. But they used to do this in the stock market, wash trading, front running, all of this stuff, right? So you always have to have a monitor. Okay. I'm not anti, regulations. I worked at a regulator basically when the NAC was still the regulator. You definitely need someone to watch the store and watch the marketplace. And that's part of the marketplace value. If you don't have people, the reason why you can go to a marketplace and you can trade amongst other people is that you have a secure kind of walled garden that you feel comfortable in, that you're in. You may not always win, but at least you're amongst some type of fairly trading kind of approach. And I think that's what this will do. You can get very detailed if you think about it. Wallets will become identities. So your identity will have things in it saying, oh, well, we're a company that is ESG focused or whatever they're doing. Yeah. And it kind of comes into social scoring a little bit, but think about it. Think about what the future is going to be like. And a company like Chainalysis is going to be, and all of those companies are going to be valued. And people are going to want to be regulated.
Let me wrap that up in 30 seconds.
The last word, you got 30 seconds.
30 seconds is on the playground. You don't want to have a fellow kid monitor it, but you also don't want the principal who's known to not always be friendly with kids. And so you have to have a third party. And this is why we have audit firms and not the government as an auditor. So I really think that exactly what Enzo said, the opportunity is quite wide. This monitoring of bad actors has to be in the hands of a trusted third party. And what's remarkable is Chainalysis is pretty well trusted already, right? And they're a third party. So I'm excited about it. The hard problem wasn't finding Chainalysis, it's getting in on Chainalysis. So if you are interested, please do let us know. We can walk you through all the mechanics and what's involved. And we're very excited about it, and we really appreciate you taking the time. Thanks, Mike Huskins. Thanks, Enzo. I think that's final word then.
Thank you, guys.
Thank you, everybody.
Thanks, everybody.
Appreciate your time, and be safe on the playground out there. Thanks.
Talk to you
Bye.
soon.
Bye now.